Hi, this is Marcus. I'm here to pay my credit card bill. Wait, why now? Your bill is not due for another few weeks. Yeah, I know. But I heard there's one date that can help my credit score if I pay before it. Ah, you're talking about the statement closing date. Exactly. Most people think the best day to pay a credit card is the due date. And yes, you should always pay by the due date. But if you want your credit score to look better, especially before applying for a car loan, mortgage, apartment, or new credit card, there is another date you need to understand. That date is called your statement closing date. In this video, I'm going to explain it in a very simple way. First, we'll quickly go over what makes up your credit score. Then I'll show you why paying before your statement closing date can help lower your credit utilization and possibly raise your score. Let's keep it simple. Your credit score is mostly based on 5 things. The first one is payment history. This is the biggest part of your score. It makes up about 35%. This simply means, do you pay your bills on time? If you pay your credit cards, loans, car payments, and other accounts on time, this helps your score. If you miss payments, it can hurt your score badly. Now, one small thing you should know. If you are 1 or 2 days late, it usually does not get reported to the credit bureaus right away. Most lenders report a late payment after it becomes 30 days late. But still, don't play with this, because even if it is not reported yet, you can still get late fees. So the simple rule is, pay on time, every time. The second part is credit utilization. This makes up about 30% of your credit score. Credit utilization means how much of your credit limit you are using. For example, let's say your credit card limit is $10,000. If your balance is $5,000, you are using 50% of your limit. That is high. Most people say keep it under 30%. But if you want your score to look stronger, try to keep it under 10%. So if your limit is $10,000, try to report less than $1,000. This is the part we care about most in this video, because the day your balance gets reported can make your score go up or down. The third part is credit age. This is about 15% of your score. Credit age means how long you have had credit. The longer your accounts have been open, the better it can be. This is why you should be careful before closing your oldest credit card. Even if you don't use it much, that old card may be helping your credit history. The fourth part is credit mix. This is about 10% of your score. Credit mix means having different types of credit. For example, credit cards, car loans, student loans, or a mortgage. You don't need to open loans just for this, but having a mix can help your profile look stronger over time. The fifth part is hard inquiries. This is also about 10% of your score. A hard inquiry happens when you apply for new credit, like a credit card, car loan, personal loan, or mortgage. Too many hard inquiries in a short time can make you look risky. Hard inquiries usually stay on your credit report for about 2 years. So when we look at all 5 parts, 2 things matter the most: paying on time and keeping your credit utilization low. Together, these 2 make up a huge part of your score. Now let's talk about the important part. Most people only focus on the due date. The due date is the last day you can pay before the bank charges you a late fee. But the statement closing date is different. Your statement closing date is usually the day your credit card company takes a snapshot of your balance. Then they send that balance to the credit bureaus. That means the credit bureaus may not see what you pay on the due date. They may see what your balance was on the statement closing date. Let me give you an example. Let's say you have a credit card with a $10,000 limit. You spend $4,000 this month. Your due date is May 25, but your statement closing date is May 1. If you wait until May 25 to pay the $4,000, you are not late. That's good. But on May 1, the bank may report your $4,000 balance to the credit bureaus. Now your credit report shows you are using 40% of your credit limit. That can hurt your score, even if you pay the full balance later. Now let's change the example. Same card, same $10,000 limit, same $4,000 balance. But this time, you pay most of it before the statement closing date. So before May 1, you bring the balance down to $500. Now when the bank reports your balance, it shows $500 instead of $4,000. That means your utilization is only 5%. That looks much better. And this can help your credit score. This is why the statement closing date matters. It is not magic. It is just timing. You are not avoiding payment. You are not doing anything illegal. You are simply making sure the balance that gets reported is low. This is especially useful if you are about to apply for something important, like a mortgage, a car loan, a rental apartment, a business loan, or a new credit card, because even a 20 or 30-point score change can matter when you are trying to get approved. It can also affect your interest rate. A better score can sometimes help you qualify for better terms. So here's what you should do. Open your credit card app. Look for your statement closing date. It may also say statement date or closing date. Then try to pay your balance down before that date. You don't always have to pay the whole card to zero, but try to keep the reported balance low. Under 10% is a strong goal. For example, if your credit limit is $5,000, try to let less than $500 report. If your limit is $1,000, try to let less than $100 report. This can make your credit profile look cleaner. Now, should you still pay by the due date? Yes, always. The statement closing date helps with what gets reported. The due date keeps you from being late and paying interest or fees. So the best move is this. Pay most of your balance before the statement closing date. Then make sure everything is fully paid by the due date. Now, one more thing. If you are not applying for anything soon, and you don't care if your score moves up or down a little, then paying on the due date is still okay. As long as you pay on time, you are doing the main thing right. But if you want your score to look its best, especially before a big application, don't wait until the due date. Pay before the statement closing date. That way, the credit bureaus see a lower balance. Lower balance means lower utilization. Lower utilization can mean a better score. So remember this, your due date protects you from being late. Your statement closing date controls what balance may show on your credit report. If you understand that one difference, you can manage your credit score much better. That's the simple strategy. Pay on time, keep utilization low, and pay before the statement closing date when you want your score to look stronger.